Chapter 2, Risk Management. In today's video, I will be going over all things risk management and position sizing. That includes invalidation, stop losses, risk reward, and position sizing. We're going to be diving into one of the most important topics in trading, something that separates the consistent traders from the ones who get wiped out due to improper risk management. Let me say this loud and clear. Trading is not just about calling direction. It's about protecting your capital so you can survive long enough to be right when it matters. Too many traders blow account after account, not because they're bad at analysis, but because they don't manage risk. So let's break down some fundamentals first that every serious trader should live by. So what is invalidation? In simple terms, it's the level or condition where your trade idea is proven wrong. It's your line in the sand. Once the price reaches that point, your setup is no longer valid. Every trade should be based on some kind of logic. Structure, pattern, a level reclaim, for example. But the moment price violates that logic or hits that stop loss or hits that invalidation, you have to accept the setup isn't playing out and move on. That's invalidation. So let's give you an example. Let's say you're going long off of a higher low in a bullish structure. If the price breaks below that low, the structure is no longer intact. Your trade idea is then invalidated. That's your exit, not vibes, not hope, just rules. So let's take a look at BTC and show you exactly what I'm talking about. We have our trading tool. Let's say we are looking to get long here and we have our stop loss below this higher low here, which I will mark out. Let's say price begins to break down here, comes down and starts making higher lows and lower highs and breaks down there. Our trade, once it hits that stop loss, it is then invalidated. A lot of traders hold on to losing trades because they have not defined invalidation. They say it will bounce soon, it's just a wick, or let me wait for confirmation, and boom, they're holding a bag and it's underwater. But when you respect invalidation, something powerful happens. You start to take small controlled losses. You live to fight another day. Invalidation also keeps things objective. You're not marrying your bias. You're not sitting in hope. You're saying, I believe in this setup, but if it gets here, I'm out. No ego, just execution. So please guys, make sure every trade you take has a clear invalidation point. That's your risk anchor. That's how you know when to stay in a trade and, more importantly, when to get out. Trust me, the faster you learn to accept invalidation, the more disciplined, confident, and profitable you'll become as a trader. What's a stop loss? A stop loss is a tool that automatically exits your position when price reaches a certain level, a level you've decided before entering the trade. It is there to protect your capital when a trade moves against you. Think of it like this. A stop loss is your safety net. It says if price hits this level, my idea is no longer valid. Get me out, no questions asked. It's your trade's invalidation level turned into an automated exit. It's basically a limit order that is going to be executed at that invalidation level. Why stop losses matter? Capital protection. A stop loss will help one bad trade turn from a full-on account nuke into a small loss. Stop losses remove emotion. It saves you from overthinking, second guessing, or hoping price comes back. It enforces discipline automatically. It enables risk management. You can define exactly how much you're willing to lose. For example, risking only 1 to 2% of your account on a single trade. This provides you the ability to take multiple losses without blowing up your account. How to use stop losses properly. Place it at your invalidation level, not just at a random number. Your stop should be at the point where your trade idea no longer makes sense. That could be below a key support, under a swing low, or past a failed breakout, depending on the setup and depending on the strategy that you are using. Never move your stop loss away from the price if it is invalidated the first time. That's how small losses turn into massive losses. Respect your level of invalidation. Use it to size your position correctly. Position size should be calculated based on where your stop is. If your stop is 2% away, size your position so you only risk 1 to 2% of your account, and we will discuss more of this later on. Only use manual stops if you are extremely disciplined. Newer traders should always use hard stop losses. I personally always use hard stop losses. Mental stops or manual stops require fast reflexes and high discipline under pressure. Stop losses don't mean you expect to lose. It means you are prepared if they do. The market doesn't care about your bias, your feelings, or your entries, but it will respect your risk management if you enforce it. Use stop losses, trade smarter, protect your capital. What is risk to reward, or RR? It is a way to measure how much you are risking on a trade compared to how much you stand to gain. It answers one simple question: is this trade worth taking based on the potential reward versus the risk involved? How it works: let's say you risk $100 on a single trade and your target is to make $300. That's a 3-to-1 risk ratio reward. And let's go and show you guys. I'm taking a BTC market long here. Again, this is not based off of any strategy, and I have a 1% stop loss, but I am targeting a 3% move. That is a 3-to-1 risk ratio. And as you can see on our long positioning tool inside of TradingView, it will tell you your risk reward ratio is 3. If, let's say, you were to win this position, you make 3x what you risk. If you lose, you're only losing $100, and that's what you are prepared to risk. Why does RR matter? It gives you an edge even if your win rate isn't high. You could win just 3 out of 10 trades, but if your average RR is 3-to-1, you'd still be profitable overall. It helps filter bad trades. If a setup only offers a 1-to-1 or worse, it might not be worth taking that risk, especially if the probability isn't high. And again, it's based off of your strategy. It brings structure and consistency. You stop chasing random entries. Every trade becomes intentional and calculated. Again, make sure that you are calculating the position before you go in it. You are calculating the trade, the take profit points, the entries, as well as the stop loss before you take the trade. It's all about planning. So how do we use RR in our trading? Define your risk first before you enter. Decide where your stop loss goes, usually at your invalidation level. Number 2, set a realistic target. Don't just throw a wild number out there. Look for key levels, structure breaks, or liquidity zones to determine where price realistically will go. Number 3, calculate the ratio. Divide the potential reward by your risk. For example, if your stop loss is 20 points and your target is 60 points, that's a 3-to-1 ratio. Only take trades that meet your minimum RR threshold. Every trader is different. You need to know your own edge and strategy. For example, experienced traders often aim for a 2-to-1 or higher ratio because it gives them a solid edge even if they don't win every single trade. Here's why. At a 2-to-1, you can be wrong more than half the time and still make money. Let's say you take 10 trades, you lose 6 of them, that's minus $600. You win 4 at a 2-to-1 ratio, that's $800. You're still up $200 even though you only have a 40% win rate at that time. That's the power of solid risk to reward. Set a minimum RR that matches your win rate and trading style. If you aim to win big trades, you have a lower win rate. You need high RR setups. If you win more frequently but take smaller profits, you can work with lower RR, but only if the math checks out. Let's head on to position sizing. Position sizing isn't just a technical detail, it's a core part of risk management. It decides how much you make when you are right and how much you lose when you are wrong. And in crypto, where volatility is wild and moves can be very fast and brutal, getting this wrong can wreck your account very quickly. So why does it matter? Number 1, it keeps your risk consistent. Let's say risk tolerance is 2% per trade, and at Wealth Group, we recommend every single trader takes 1 to 3% risk on each trade. If you are trading random position sizings, sometimes big, sometimes small, your 2% goes out of the window and you might accidentally risk 5 to 10% without even realizing it. A consistent position size based on your stop loss helps you stay in control of your risk, and it keeps your emotions in check. Number 2, it helps you survive volatility. Crypto isn't like Forex or stocks. A 5% candle is normal. A 15% wick, it happens. If you size too big and get caught in a volatile move, you'll get stopped out very badly, or worse, liquidated. If your bias was correct, proper sizing lets you weather the noise and focus on your edge, not just the chaos. Number 3, it stops emotionally led trading. Oversized positions lead to panic. You start second guessing everything, watching every single candle, sweating over every pullback. When your size is dialed in, you can execute with confidence, and it keeps your emotions out of that trade. Number 4, it lets you trade more and not just YOLOing one setup. If you size correctly, you're not putting half your account to one setup. You've got the flexibility to take multiple high conviction trades without overexposing yourself to any single one. It's how pros operate. Controlled exposure, multiple opportunities, and long-term growth. So let's get in and I'll show you exactly how to use the long and short positioning tool inside of TradingView to calculate position sizing and make sure that your risk is dialed in. So let's say if I want want to take a market long on BTC here and I have stops below these lows, again, it's going to be dependent on your strategy of where your entries are and your stop losses are, as well as your take profit points. But let's say if I have a 1% stop loss, I am going to be targeting either 1% take profit point or higher, 2%. So a 2-to-1 RR trade. Now, what I'm going to do is I'm going to double click on the long positioning tool. You can do this for a short positioning tool. And let's say I have an $1,000 account. Make sure to put that into the account size column there. Your lot size is always going to be 1. And let's make sure that our risk is anywhere between 1 to 3% on this trade. Okay, I press on the long position tool. I press OK. Now, since I have a $1,000 account, what I'm going to do is I'm going to click on the long positioning tool or short positioning tool, and you can see the quantity size. So in this instance, I'm going to be longing 0.008 BTC so that if I were to get stopped out, I'd only be losing $10 of my account. Now, if it were to hit my full take profit point, I would be gaining $20. All right, guys. At the end of the day, trading isn't about catching every move or being right all the time. It's about managing your risk so you can stay in the game long enough to let your edge play out. Set your stop loss, respect your invalidation, know your risk to reward ratio. That's the foundation. That's how you build consistency. No risk management, no longevity. The game rewards the discipline, not the reckless. So protect your capital, follow your plan, and remember, you're not here to look smart, you're here to last.